Okay, Assalamualaikum warahmatullahi wabarakatuh and selamat sejahtera. Okay, now I would like to explain about MFRS 108, accounting policies, changes in accounting estimates and errors. Okay, first of all, let's have a look at the learning outcome. Okay, at the end of this topic, students should be able to define accounting policies, accounting estimates and errors, explain the accounting treatment for changes in accounting policies and changes in accounting estimates, explain the accounting treatment for prior period error and current period error, and the last one, explain the disclosure requirement. Okay, first of all, the introduction. Okay, sometimes an entity may need to change their accounting policies and estimates or find material errors in the prior year's financial statements or during the current year. But the question is, under what circumstances entities can change their accounting policies and accounting estimates? Another question, what should they do when the material errors are identified? Okay, first of all, I would like to explain to you about the accounting policies. Okay, what are the accounting policies? According to MFRS 108, accounting policies are specific principles, bases, conventions, rules and practices adopted by an entity in preparing and presenting financial statements. Okay, how to select which accounting policies to apply? Okay, first of all, an entity may refer to the relevant standards or interpretation which is applicable to a transaction, event, or condition. For example, when an entity acquires a property that is not used for its operation, then the entity has to apply the requirements of MFRS 140 investment property. Okay, second, in the absence of a standard or interpretation, management of the entity is to use its judgment in developing and applying an accounting policy. Okay, for example, an entity may apply its own judgment to decide whether the portion of a property that is owner-occupied is significant or not in terms of its percentage. Okay, this judgment should be applied in order to classify the whole property as either an IP or PPE when the portions of the property cannot be sold separately. Okay, the examples of accounting policies. Okay, first, according to MFRS 116, okay, the entity can select the cost model or revaluation model as its accounting policy for subsequent measurement of PPE. Okay, another example is for inventory valuation. Okay, an entity can choose the most suitable method, for example, weighted average or FIFO. And for MFRS 140, the entity can select the cost model or fair value model as its accounting policy for subsequent measurement of investment property. Okay, alright. So this is the examples of significant accounting policies adopted by KFC Holdings Malaysia Berhad. Okay, usually the significant accounting policies of a company can be found in the notes to the financial statement. Okay, this is the accounting policy in relation to the PPE and depreciation. Okay, you can find this significant accounting policies adopted by a company in the notes to the financial statements. Okay. Alright, when there is no specific standard or interpretation, that can be applied by an entity, the management of the entity is to use its judgment in developing accounting policy that results in information that is relevant for users to make economic decisions and reliable, where the financial statements present faithful information, reflect the economic substance of transactions, not merely based on legal form, neutral, prudent, and complete in all material aspects. Okay. Okay, this one is about changes in accounting policies. All right. Okay, to enable users of financial statements to make a comparative study of the financial statements of an entity, okay, the entity must select and apply its accounting policies consistently from period to period or for similar transactions, events, and conditions. Okay, consistency allows users to analyze the trends in financial position, performance, and cash flow of the entity. Okay, although accounting policies selected are to be applied consistently, okay, there are circumstances when a change in accounting policy is allowed. Alright, so basically an entity can change its accounting policies, okay, under one of the following circumstances. Okay, first, when the change in accounting policy is required by MFRS, or it is known as a mandatory change. Okay, so when the change in accounting policy is required by MFRS, okay, the entities have no choice but must comply with the new law or standard. Okay, for example, okay, companies are required to adopt MFRS 15 starting from 1st January 2018. Okay, the new standard provides a more comprehensive revenue recognition and replaces the previous standards, previous revenue standards, such as MFRS 118. Okay, the second circumstance, okay, is discretionary change or voluntary change. Okay, so the company may also change its accounting policy voluntarily. Okay, so this is dependent on the judgment, okay, of management of the entity in deciding whether a new policy would be more appropriate than the policy in use. Okay, the change results in the financial statements providing reliable and more relevant information. Okay, for example, the company can change from cost model to fair value model for subsequent measurement of investment property based on MFRS 140. Okay, the use of fair value, okay, is to provide reliable and more relevant information to the users. Okay, so the users of financial statement, especially the shareholders, okay, may be interested to know information about the current market value of the properties, okay, invested by the company. Alright, when a company changes its accounting policies, okay, the company needs to apply the change retrospectively. Okay, what is a retrospective change? Okay, it means the adjustment is done as if the new accounting policy had always been applied before. Okay, for example, when the change of policy is decided in year 5, okay, the company must apply the change for year 4, year 3, year 2, and year 1. Alright, adjustment to the opening balance. Okay, retrospective adjustment requires an adjustment to the opening balance of retained profits as well as other affected accounts. Alright, so when a company, okay, changes its accounting policy, the company has to make a retrospective adjustment or retrospective change. Okay, so the adjustment needs to be done, okay, to the opening balance of retained profits. Okay, this is the meaning of retrospective application. Okay, so it means applying a new accounting policy as if that policy had always been applied. Alright, the second one, okay, I would like to explain to you about the changes in accounting estimates. Okay, due to uncertainties inherent in business activities, many financial statement items cannot be measured precisely, but can only be estimated. Okay, the estimation process involves judgment based on the latest available information that is reliable. Okay, for example, based on the current economic situation, the company may need to increase or decrease the rate of allowance for impairment of trade receivables, or the company may need to revise, okay, the economic useful life of its assets, okay, depending on the current usage of the asset. Okay, these are the examples of accounting estimates. Okay, so the examples include allowance for impairment of trade receivables, okay, economic life of depreciable assets, and depreciation rates. Okay, so the change from indefinite life to finite life of intangible assets. This one is also a change in accounting estimate. All right. And then the estimates may have to be revised due to changes regarding the circumstances as a result of new information or more experience or subsequent development. Okay, for example, when the economic situation is not very good, the company may decide to increase, okay, the allowance for impairment of trade receivables. Okay, or when the company notice that an asset of the company has more frequent usage than usual, okay, the company may decide to shorten the economic useful life of the particular asset. Okay, according to MFRS 108, okay, a change in accounting estimate is defined as an adjustment of the carrying amount of an asset or liability, or the amount of the periodic consumption of an asset that results from the assessment of the present status of and expected future benefits and obligations associated with assets and liabilities. Okay, so changes in accounting estimates result from new information or new development, and accordingly are not correction of errors. Okay, so that is the meaning of change in accounting estimates, okay, according to MFRS 108. Okay, when an entity changes its accounting estimate, okay, the adjustment has to be done prospectively, okay, in the so-called in the period of the change. Okay, if the change affects the period only, for example, the change in allowance for impairment of trade receivables. So if there is a change in allowance for impairment of trade receivable, okay, the adjustment has to be done in the period of change. All right. And another type of adjustment that has to be done, okay, in relation to changes in accounting estimate is in the period of the change as well as future periods. Okay, if the changes affects both. Okay, for example, a change in estimated useful life of an asset. So when the company has changed the estimated useful life of its asset, the company has to make adjustment, okay, during the period of change as well as future periods. Okay, for example, the company has to make adjustment on the depreciation expense during the current period as well as in the future periods. All right. Okay, this one about the meaning of prospective application, okay, or prospective adjustment. Okay, prospective application means applying the new accounting estimate to transactions or events occurring after the date the estimate is changed, okay, and recognizing the effect of the change in the current and future periods affecting by the change. All right, let's have a look at this example. Okay, this example is about changes in accounting estimates. Okay, let's read the example. Okay, on 1st January 2011, Kiamang Berhad bought a machine for 150,000 by cash. The machine is expected to have a useful life of 10 years with no scrap value. Okay, however, in January 2015, due to frequent usage which exceeded the recommended guideline, the company decided to change the estimated useful life from 10 years to 8 years. Okay, let's say the current financial year end of this entity is on 31st December 2015. Okay, so actually the situation is about the change in accounting estimates. Okay, so since the company has decided to change the useful life of its machine from 10 years to 8 years. Okay, so this is about the change in accounting estimates. So the adjustment has to be done prospectively. Okay, so what adjustment? The adjustment that has to be done is we need to calculate the new depreciation amount. Okay, in the year 2015. Okay, to calculate the depreciation amount in year 2015, we have to find the carrying amount of the machine on 1st January 2015. Okay, as we all know, the machine was bought on January 2011, on 1st January 2011. So in January 2015, okay, the machine, okay, has been used for 4 years already. Okay, so the machine has been depreciated for 4 years already. So the carrying amount of the machine, okay, is 150,000. The cost, okay, minus the accumulated depreciation for 4 years, okay, that is 60,000. Okay, 4 years times 15,000. Okay, this is the prior depreciation expense, 15,000. Okay, so we get 90,000, the carrying amount on 1st January 2015. So we divide with the remaining useful life of the machine. Okay, the remaining useful life of the machine now becomes 4 years. Okay, so previously, okay, the remaining useful life, okay, was 6 years. Okay, 6 years. Okay, but after the change, okay, the remaining useful life of the machine is 4 years. All right, so we get the new depreciation expense is 22,500. Okay, so this is the journal entry, okay, for the adjustment. Okay, first we have to debit SOPO depreciation expense 22,500. Okay, this is the new depreciation expense that we have to record in year 2015. Okay, and credit the accumulated depreciation 22,500. So in the following years, we must also record the same amount of depreciation, 22,500. Okay, so next, this one is about errors. Okay, an entity may discover errors, okay, during the current period which relates to a prior period. Okay, according to MFRS 108, okay, prior period errors are omissions from and misstatements in the entity's financial statements for one or more prior periods arising from a failure to use or misuse of reliable information. Okay, financial statements do not comply with MFRS if they contain material errors or immaterial errors that are made intentionally. Okay, so these are the examples of errors. Okay, so the example of errors include mathematical mistakes. Okay, for example, miscalculation of formula. All right, and then mistakes in applying accounting policies. Okay, for example, the company has changed its inventory valuation policy from FIFO to weighted average method. But during the current period, for example, the company has still applied, okay, the FIFO method instead of the weighted average method. Okay, and then misinterpretation of facts. Okay, for example, capital expenditure is recorded as revenue expenditure, or revenue expenditure is recorded as capital expenditure. Okay, next is fraud. Okay, fraud is also categorized as an error. Okay, fraud refers to an error that is intentionally made by someone to deceive others. Okay, and another example is oversights. Okay, oversights, okay, meaning failure to notice or do something unintentionally. Okay, for example, Okay, the company is supposed to make payment to supplier A, okay, but the payment was made to supplier B, okay. Alright, okay, basically there are two types of errors. Okay, the first one is the prior period errors and the second one is the current period errors. Okay, so if a company, okay, discovered a prior period error, okay, the company has to correct the material error retrospectively. Okay, the company has to make a retrospective adjustment, okay, when there is a prior period error. Okay, so a retrospective adjustment, okay, requires an adjustment to the opening balance of the retained profits, okay, as well as other affected accounts. Okay, the second type of error is the current period error. Okay, for this type of error, the company has to correct the error prospectively. Okay, or the company has to make a prospective adjustment. Okay, so for current period error, the company has to make adjustment to all the affected accounts during the current period. Okay, so this is the example for errors. Okay, let's read this situation. Okay, first, okay, Encik Muhammad, the accountant of Kiaman Berhad, is currently reviewing some accounting done by one of the trainees in the accounting department. While scrutinizing, okay, some of the transactions for the year ended 31 December 2019, he found the following information. Okay. First, payment made to Bunga Supply Trading on 1st July 2019 totaling 100,000 was recorded in the books of Bingo Supply Trading. Okay, so this is a current year error. Okay, this situation is about the current year error. So the adjustment has to be made prospectively. Okay, the adjustment has to be made prospectively. Okay, so the journal entry, okay, to correct the error is the company has to debit Bunga Supply Trading 100,000. Okay, so this is the correct one. Okay, the company has to debit Bunga Supply Trading 100,000 and credit, okay, Bingo Supply Trading 100,000. Okay, this is the to offset, okay, the payment made to Bingo Supply Trading. Okay, this is the error made by the company. So to offset the error, the company has to credit Bingo Supply Trading 100,000. Okay, this is also another example of errors. Okay, in 2019, it was discovered that a payment made to trade suppliers totaling 100,000 in 2018 was accounted as employee salaries. Okay, the situation is about prior period error. Okay, so the adjustment has to be done retrospectively. Okay, why it is a prior period error? Because the error was made in 2018, yeah, and it was discovered during the current period. But the error was made in the year 2018. That is in the previous period. So the adjustment has to be done retrospectively. Okay, so the journal entry to record, okay, to make the correction, we have to debit account payable, okay, 100,000, okay, and credit retained profit. Okay, this one we have to credit the opening balance of the retained profit, okay, in year 2019. Okay, 100,000. Okay, why we have to credit the retained profit? Because this is a retrospective adjustment. Okay, so as we all know, the company, okay, has accounted, okay, 2018 in 2018 the payment made to a supplier as employee salary. So the profit in year 2018, okay, the profit in the previous year was underestimated or understated. Okay, because the payment, the transaction was recorded as expenses, okay, in the year 2018 instead of as a settlement of a liability. Okay, so the profit in the prior year was understated. Okay, so what we need to do is we have to increase the profit. Okay, by crediting the opening balance of the retained profit in year 2019. Okay, in the current year. Okay, amounted to we have to increase by 100,000. Okay, so to increase the profit, okay, we have to credit the retained profit account. Okay, when we have to reduce the profit, okay, we have to debit the retained profit. Okay, so this is the journal entry, okay, for the adjustment on the prior period error. Okay, so that's all for now. Thank you so much. Okay, Assalamualaikum and salam sejahtera.